These are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
Given the forecast that you have, what justified not moving today, and what could justify moving in the future if you think inflation is coming down? In other words, why did you leave that extra dot in?
Well, I think we have come very far, very fast in the rate increases that we've made. And I think it was important at the beginning that we moved quickly, and we did. And I think as we get closer to the rate that we think, the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time, the risks become more two-sided. And the risk of over-tightening and the risk of under-tightening, it becomes more equal. And I think the natural common sense thing to do is as you approach that, you move a little more slowly as you get closer to it. And that's what we're doing. So we're taking advantage of the fact that we have moved quickly to move a little more carefully now as we sort of find our way to the right level of restriction that we need to get inflation back down to 2%.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge and that by the time you meet in November that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was the what factors?
The base factors.
Base factors. Okay. So on that, we're looking at just monthly. Right, you can look at just monthly readings and see what the increase was from the prior month. So you're right. When you go back 3, 6, and 12 months, you get base factors, but we can adjust for that. In terms of not getting data, again, we don't comment on government shutdowns. It's possible if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility.
But would you feel more comfortable on the base effects that as those kind of fall out of the equation for the next couple of readings by November, would you feel more comfortable at that point?
Yes. I mean, if you're looking, we can tell how much inflation has gone up in a given month, right? And that's what we're looking at. And month by month, what's the reading? And, I think what we're really looking at is there's a tendency to look at, shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation, things like that. That's just things we have to monitor. So.
On the consumer, they're putting more and more of this on their credit card. The consumer seeing record credit spending. How long do you think the consumer can manage that debt at higher interest rates now? And are you concerned about a debt bubble related to that?
So to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. Turning to consumer credit, of course, we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently, during and after the pandemic. They're now moving back up to normal. We're watching that carefully. But at this point, these readings they're not at troublingly high levels. They're just kind of moving back up to what was typical in the pre-pandemic era.
Hi, Jean Young with M&I Market News. Yields along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks, and how much of it can be attributed to macro explanations and how much to technical factors? Thank you.
So you're right. Rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things, either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. But essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. The common explanations that you hear in the markets kind of make sense.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing. You said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their recent historic lows, how is that going to impact future thinking about taking interest rates to that lower bound in the future?
So on the supply point, of course, supply is very important over time in setting house prices and for that matter, rents. And supply is kind of structurally constrained. But in terms of where inflation's going in the near term, though, as you obviously know, a lot of it is leases that are running off and then being re-signed or released at a level that's it won't be that much higher. A year ago it would have been much higher than it was a year before. Now it may be below or at the same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think I would look at the lock-in. The idea being that people are in very low rate mortgages, and even if they want to move now, it would be hard because the new mortgage would be so expensive, and that's explaining that's one of the explanations for what's happening broadly in the labor market. Would that play a role in our future decisions in a future loosening cycle about whether we would cut rates? No, I don't think it would. I mean, I don't think that's. I think we'd be looking at what fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road, I wouldn't think so.
Nancy.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that that could contribute to an economic slowdown or even a recession?
Well, that's always a concern. Concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So that said, of course, we also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed-rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences, in the sense that if you're a relatively wealthy household with a long fixed-rate mortgage, the past year has not been all that tough with rates going up, whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
So I guess it's fair to say that the economy's been stronger than many expected, given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood, and so that spending is held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. It could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market, but that's coming back into balance. We were making progress on inflation. Growth is strong, but I think by many forecasts, many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question your second question was distributional, but can you be a little clearer about that?
My point there was that if you're somebody who has a long fixed-rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people, as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are, who are living on credit cards and borrowing are going to feel that more. They are. And of course, people with lots of savings also have a much lower marginal propensity to consume, and so it's not going to affect them as much.
Let's go to Greg Robb for the last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate-income Americans. I have two questions about this. Are you going to use that data to maybe come up with sort of like a quarterly survey of those groups, like the Senior Loan Officer Survey? And and also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? And just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly we're suffering from high inflation. I think during the pandemic, the government transfers that happened were very meaningful. And if you know the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages, and you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy is terrible, but at the same time, they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be. But I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low-wage jobs. And now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's all day long here at Bloomberg, and this update brought to you by Glenmead. Glenmead offers sophisticated wealth and investment management solutions combined with the personalized service you deserve. Your wealth, your mission, your investments. Let's talk. Visit glenmead.com to learn more. Federal Reserve leaves rates unchanged while signaling one more hike this year. Here's Fed Chair Jay Powell live at the news conference, as you heard it right here on Bloomberg Radio.
Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate.
Stocks are
Our decisions will
whipsawed.
be based on our ongoing assessments of the incoming data and the evolving outlook and risks.
Stocks whipsawed after Jay Powell said Fed officials decided to stay on hold in September in light of how far they have come, while adding that the central bank is prepared to tighten further if necessary. S&P down right now. The S&P 500 index down 17 points, a drop there of 0.4%. The Dow higher by 82, up 0.2%, while NASDAQ is down 107, lower by 0.8%. The NASDAQ 100 index down 111, down 0.7%. 10-year yield 4.34%, with a 2-year 5.13%. Spot gold up $8 the ounce to $19.39, up 0.4%. And West Texas Intermediate crude down 1%, $90.28 a barrel. WTI right now, as I mentioned, moving lower by 1%. Brent, the global benchmark, $93.35, lower by 4.1%. Again, recapping, S&P down 18, now lower by 0.4%. 10-year yield 4.34%. Our Fed coverage continues. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
Very good afternoon, everyone. On this Fed Wednesday, as you well know, September 20th, 2023. Carol Masser along with Tim Stenivek live in our Bloomberg Interactive Brokers studio on YouTube and, of course, on Bloomberg Original. So this is the 6th meeting of the FOMC. It's done, Tim.
It is done. And we just wrapped up listening to Fed Chair Jay Powell talking about the decision and the economy and what's to come. Well, you know what, Carol?
What?
The Fed leaves rates unchanged, signals one more rate hike this year. Powell says central bank to proceed carefully on a rate path.
Carefully. How many times? It was like a
Carefully.
drinking game. Every time he said careful or carefully.
I hope you weren't drinking during that.
Well,
because
maybe some water.
You would be drinking a lot. And then 2-year Treasury yields, they went flat after that initial surge.
Unbelievable. All right, so let's get to it. I will say the Fed chief saying that there's so much uncertainty around the timing of rate cuts, and that was something I felt like in the press conference that reporters were trying to pin him down to, and he would not be pinned, although it does feel like higher for longer. All right, so let's get to it. Let's get some analysis because we did get an an update on those economic projections from the Federal Reserve, and that was certainly something we were all focused on. What we have with us, or who we have with us, a former Bloomberg colleague, Yelena Shaletyeva, senior U.S. economist at BNP Paribas on Zoom in New York City, and in Bloomberg Economics U.S. economist Stuart Paul. He's here in our Bloomberg Interactive Broker studio. Stuart, I do want to start with you. What are or were the key points of today's decision and what Jay Powell chose to stress in that press conference?
So Powell is definitely stressing that he's going to be maintaining a higher for longer posture. I think that some of the confusion that came from the press conference is that this is just a generally hawkish summary of economic projections. That's really the content of today's FOMC decision, is the summary of economic projections, showing far fewer cuts in 2024, more optimistic GDP growth path. But for some reason, Powell, when he took to the podium, said that a soft landing is not his base case. It's almost as
What does
though...
that mean?
I was very surprised to
So
hear
what,
that.
what does that mean? That means things are better?
No,
Tim?
I mean, I took it as bad news. I took it as, things aren't as good as people think.
Well, we here at Bloomberg Economics think that there is some softness underneath the surface. I think that if we're trying to analyze the intent of the Fed chairman here, we have to think that he's trying to invoke some sort of a memory of Volcker, which is that he's willing to do what's necessary to break the back of inflation. Yes, he's optimistic about growth. That's why the median member of the FOMC at least is optimistic about growth. That's what helps to explain the median projection for the Fed funds rate, maintaining that higher for longer posture, ending 2024 at 5.1% in the 5 to 5.25 range. And if the Fed is ever going to have to rein in inflation, maybe something might have to crack. That's what I think that he was alluding to when he says that a soft landing isn't necessarily his base case.
And Bloomberg Economics' Anna Wong writing, officials also completely scrapped a recession forecast for this year. Right. So definitely taking that off the table.
Hey, Yelena Shaletyeva, come on in here. Senior U.S. economist at BNP Paribas, also our former colleague here at Bloomberg. Yelena, how did you read into that comment from Fed Chair Jay Powell? He would not call this soft landing a baseline expectation. What's your interpretation of that?
I think the chair is alluding to some event risk here, and I think there is a lot of things that could go wrong from now on. Yes, the economic growth looks really strong if you look at the recent data, but we have a confluence of significant negative risks coming all at the same time in the fourth quarter of this year. You have student loan repayments restart. You have a possible shutdown, excess savings are depleting. So there are significant risks to the soft landing scenario that is reflected in the summary of economic projections. They're really seeing a stronger growth, lower unemployment rate, at the same time, much lower inflation. I think the event risks that will make them be cautious at the following meeting.
If you could have asked a question to the Fed chair, Yelena, what would it have been?
I think I wanted to hear a much clearer explanation of what he thinks about policy legs. He alluded to that a little bit in the opening remarks, but the extent of how much previous policy tightening impacted economic growth, I would like to get a better sense of that. It seems like Chair himself believes that policy legs have not fully percolated through the economy and more impact is coming.
Well, and Stuart, I want to ask you, process of getting inflation to 2% has a long way to go. So do I read that as, yep, we're not at 2% yet, so we get that, Chair Powell, or is it that also means you guys still have work to do? And so cool your jets, everybody who's thinking of Fed cuts.
The projected path for the Fed funds rate target range, at least for the median voter on the FOMC, seems to be almost separate and apart from the economic fundamentals that they're showing in their projections. We're not getting to the 2% core PCE target until 2026. So yes, the core PCE forecast was modestly revised down for 2023, but we also see growth being revised up. We see unemployment being revised down, labor market staying tighter for longer. That's not the higher for longer, the tighter for longer that the Fed had been looking for, right? So do those fundamental economic projections, those forecasts, scream one more rate hike to you? I mean, it seems as though, to Yelena's point, that maybe these optimistic projections are just that. Maybe they're just a little bit of a wish and something will crack in the background. Maybe it's something fundamental like Yelena was talking about that we've written about extensively. Maybe it's something like liquidity, and we haven't heard anything about QT in multiple press conferences.
Well, Yelena, Stuart raises a really good point. I mean, how seriously can you take the dot plot out 2 years? It's one thing to, take the dot plot projections out for the remainder of the year, but it's an entirely different thing to look at it for the end of 2025. How do you look at different times there versus what they're saying?
I think you really have to take it with a grain of salt, even going into the next year. We did notice that the range of projections for 2024 narrowed, but it's still a very wide range of totally different projections. And even this year, I think the fact that the Fed downgraded inflation projections, but they are still, I think, in our view, are very high relative to what will likely happen. So in this sense, if inflation surprises to the downside closer to the end of the year, that will give them a way out of the last projected hike of the cycle. We think that they have reached the terminal rate.
Is there a word that you seize on in terms of what came out of Jay Powell's mouth today, Yelena?
In a sense,
is there a word that just sometimes he uses a word over and over. Sometimes there's a phrase, and we all kind of, that's in the headlines. It used to be transitory. It used to be transitory, data dependent, right? How many times have we said that? Is there anything that came out of his mouth that you thought, okay, this is kind of where this
data dependency? But that has been their mantra for quite some time. I think that they just want to be cautious with those, sticky words.
How about for you, Stuart? Was there something there?
No, the thing that really stood out to me was that Jay Powell didn't seem to strike, at least not to me, a single hawkish or dovish tone. Usually, at least over the past few years, when the FOMC makes a decision, so in this case, to hold rates steady, he'll end up striking a more hawkish tone to compensate for the pause in rates. Or if they were to hike, he ends up coming out a little bit dovish during the press conference to sort of tone down any sort of market reaction to the actual decision itself. That was not the case today during the press conference, at least not to my ear.
What did you hear?
To my ear, he sounded a little bit cautious. He used the word cautious multiple times. And they were just the same way that we see this sort of break between the FOMC's median forecast for the funds rate itself and its forecast for the economic projections. it seems that there wasn't a cohesive narrative, at least not to me, when I was listening to the press conference.
It's interesting, right?
Totally. To Stuart's point, if I may,
please.
there's a lot of risk management approach in what they're doing right now. Not that they have achieved the goal, but they're very cautiously moving along. It's risk management that is driving their decision at the point.
All right. So, okay, where do we go from here? And I guess it's, Yelena, what are the next kind of focal points for you? Is it just we're going to go from data point to data point? I mean, how do you think about November?
So we only get one more CPI report and one more payrolls report before the November meeting. So, I mean, they are saying they're data dependent, but there's really not that much data that they're going to get. I think what will keep them on hold at the next meeting is really the event risk. So again, I mentioned a lot of things that are coming that could influence their decision to be even more cautious in the near term. But I think by the time they get to the end of the year, to the December meeting, we will probably get a lot of data showing a significant slowdown in economic growth, and even further slowdown in the labor market. And eventually that would stop them from going another time, as they are projecting in the summary of economic projections.
Stuart, I like the way that Yelena described event risk, these things that we talk about that the Fed absolutely has no control over. Something that Jay Powell said, higher oil prices, UAW strikes, student loan payments starting up once again. What's the biggest event risk on your radar right now?
I'm not sure this is entirely an event itself. It is a catalyst that's starting, but it's well signaled, right? We know that student loan repayments are going to be starting. In fact, student borrowers have started those repayments already, and flows into the Department of Education's coffers within the Treasury have already reached pre-pandemic flows. So that typically should, based on typical flows into the Department of Education, shave off something like 50 basis points from PCE spending on a monthly basis. I think that's what's biggest to me. Other things like the UAW strike, imagine that's temporary, shave something like 1 percentage point off of industrial production. That's the sort of thing that you get back, though, when they fire up the assembly lines again. Same thing goes with the government shutdown. We would not even see that show up in the establishment survey if any sort of federal agency still keeps workers on its payrolls, at least insofar as those workers will receive back pay when they are brought back to work. At the end of a shutdown, even a government shutdown wouldn't hurt non-farm payroll growth that much. But the extent of, the Board of Governors is sitting there on Constitution Avenue. It's the sort of thing that they would see firsthand when economic activity within the district slows to a halt during a government shutdown. So it's the sort of thing that can feel very scary to policymakers.
Right. I always think about with these kind of things, it's either kind of a one-off if it ends quickly.
Right.
The longer these things lag on, I assume the economic impact is so much greater. Yelena, it was kind of fun, I guess, to kind of watch Jay Powell deal with, trying to be pressured into, when do we cut rates? When does it come? He says going into 2024, the time will come at some point, and I'm not saying when, to cut interest rates. So he's very careful about that. How do you think about when we will start to cut rates?
So in our view, we will slip into a recession, and that will be a modest recession in our view, but still that should push the Fed to start cutting rates. Another consideration is something that came up during the press conference is the level of real rates. So if inflation continues to slow down and it falls rapidly, that would push real rates much higher from where they are right now. They're already in the restrictive territory, and the Fed will just not want to keep pushing real rates even higher into the restrictive policy stance. So at some point, the Fed will have to cut nominal rates just to keep real rates from rising further. So, and we think that that time will come sometime in the middle of next year.
You have any thoughts on that?
No, I think that that's generally right. I think it's in the middle of next year. I wouldn't be surprised to see something like 25 basis points in meetings starting from June, July. And it's exactly that. It's to maintain that constant spread between printed inflation and nominal policy rates, so that monetary policy stays sufficiently restrictive but not excessively restrictive. I think that just, Tim, to your question earlier, thinking about any sort of catalyst that could be shocking, that could materially change policy decisions. It seems as though people have entirely stopped discussing liquidity and they've entirely stopped discussing the consequences of QT. But the Bank Term Funding Program has maintained essentially a constant balance. Banks are still continuing to borrow from the Federal Home Loan Banks, and we're still seeing deposits leaving the banking system because rates are materially higher.
You're talking about the fallout from the regional bank crisis.
Well, even preceding the regional bank crisis, as a consequence of quantitative tightening, the other aspect of monetary policy that's operating just sort of in the background, there is an attempt to soak up liquidity at the Fed. And though we always focus on the Fed's dual mandate, price stability and full employment or maximum employment, the sort of thing that could pop up in the background is a liquidity event. And those sort of events tend to be pretty convex. We don't really have the foresight of saying, student loan payments are starting in October again. They happen when they happen, and I'm surprised that it's the sort of thing that doesn't come up in press conferences anymore.
I mean, COVID happened when it happened. March 2020 happened when it happened. These are things that, if you go back to 2019 and the summary of economic projections then, nobody was foreseeing something like this, an event risk like this, causing the Fed to drop rates to zero.
No, exactly. I mean, I don't know. I mean, you think about this year, Yelena, and I feel like we've been all over the map, right? When it comes to, we thought kind of the world was coming to an end, mini end, with the regional bank crisis, but, we've dealt with crypto over the last year. I mean, there's been a lot of things that have certainly come at this market, but, here we have an environment where you see certainly equity strategists continuing just to kind of ratchet their estimates higher. But at the same time, I'm looking at, and stocks right now are down to their lows of the session, but I'm looking at, the rate moves today, your 2-year at 5.14, 10-year at 4.3. I mean, 5-year at 4.53. I mean, are these the rates that we should anticipate we'll continue to see, certainly going into 2024?
Well, at some point, the Fed will have to cut rates, and we will see some movement on that front.
Right.
I think one thing I would like to highlight, though, is all these things that we mentioned in our discussion, like such as student loans and strikes and, the depletion of excess savings. We should not forget about that, even though we've been talking about it for a long time. Those things make the economy more vulnerable to exogenous shocks. So some type of liquidity events and other things that Stuart mentioned. So, I think that the slowdown in the economy to the point at which it approaches somewhat some stall speed, that makes the economy really vulnerable to something that could happen that we cannot anticipate. And that's an important point, and this is something that we should be watching.
Yeah. I mean, there's a lot on the plate. Certainly a lot covered by Jay Powell today, but a lot for us to kind of continue to mull over, and we'll see how the financial markets continue to read it. Guys, thank you so much. Really appreciate it. I know you guys have had a busy afternoon watching all of this, so great to get your insight.
Stuart was here late last night. I saw you on TV late last night.
What were you doing?
Were getting
Are you doing a preview?
Australia daybreak.
Oh, yeah. Well, I mean, somebody's got to do it.
A lot of central banks right now, right? Making moves.
Somebody needs to talk about starts and permits. Somebody needs to talk about what to anticipate from the Fed. So it's been a busy day for us. Yelena, we miss you here at Bloomberg. Eliza says hello.
We do miss
all the best over there.
I miss you guys too.
Well, you know what? We love it when you get to join us, Yelena, and on Fed Day and anytime. So it's awesome to have you back with us.
Totally. All right, be well. Yelena Shaletyeva, senior U.S. economist at BNP Paribas, as you know, a former Bloomberg colleague, and Stuart Paul, U.S. economist at Bloomberg Economics, part of the Bloomberg Economics team. Yelena was previously. All right, everybody, let's get a check on some of your top business stories and a look at the trade. We definitely are seeing it play out in both the Treasury and equity trade. Charlie Pellet.
Thank you very much, Carol Massar. Indeed, lows of the day. We begin with the equity market with the S&P down 35 points right now, a decline there of 0.8%. We've got the Dow Jones Industrial Average dipping into the red, was higher last update, but right now down by 40 points, a decline there of 0.1%. And the NASDAQ Composite Index down 178 points, a drop right now of 1.3%. Fed Wednesday, we've got the 10-year yielding 4.35% with a 2-year 5.15% right now on the 2-year yield. Spot gold up $4 the ounce, up 0.2%, $19.35 right now on gold. And West Texas Intermediate crude down 1%, $90.28 a barrel for WTI. Federal Reserve today leaving its benchmark interest rate unchanged while signaling borrowing costs will likely stay higher for longer after one more hike this year. And Fed Chair Jay Powell, you heard him live on Bloomberg Radio saying, yes, there is plenty of uncertainty.
It's the strike, it's government shutdown, resumption of student loan payments, higher long-term rates, oil price shock. There are a lot of things that you can look at. So what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things.
Bottom line, hawkish Fed with Powell saying officials are prepared to raise rates further if appropriate. Reaction to today's Fed action from Diane Swonk, chief economist at KPMG.
I think what's really important in what the Fed just did was the whole concept of higher for longer, much higher for longer, and potentially a higher neutral rate on the other side of this. This is what the theme was coming out of Jackson Hole Symposium, was how synchronous the idea of higher for longer mantra is across the developed economies.
Stay with Bloomberg for ongoing discussion about today's Fed decision and market reaction. Again, recapping S&P down 35 points right now, low of the day down just about 0.8%. We've got the 10-year yielding 4.36%, the 2-year 5.15%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, it's 3:47 on Wall Street here in New York City, and so we've just got about 12 minutes left in today's trading session. A Fed day. We've only got 2 FOMC meetings left, November 1st and then December 13th, but the Fed did not change its key interest rates, kept that unchanged, but did give an update in terms of its projections when it comes to the economy, to inflation. So we did get kind of what the Fed is thinking and where things go from here.
Yeah, it was hawkish nonetheless. 12 Fed officials seeing one more hike this year, 7 seeing rates on hold. The Fed also repeating language on the extent of additional policy firming. Let's hear what our next guest has to think about it. Larry Pitkowski is co-founder, managing partner, and portfolio manager at Good Haven Capital Management. Larry joining us on Zoom from Millburn, New Jersey this afternoon. Larry, how are you?
I am well. How are you, Tim?
Yeah, we're doing pretty well. Really digesting not just what Jay Powell said, but also the market reaction to this. We should note that NASDAQ, pretty much at its lows of the day, is down 1.3%. The S&P 500 down 0.8%. Stocks moving kind of all over the place when we heard from the Fed chair. What's your assessment?
You know, Tim, I'm glad you had me on this show on a Fed day because I get to use my 3 favorite words in investing, which is, I don't know. Okay.
Thank you for your honesty. Interview over.
And that's not doesn't mean I wouldn't like to know, but there are many important and unknowable things in investing. And I think one can obsess over them all you like, but an enormous amount of energy may not yield you many results. And here at the Good Haven Fund, we try very hard to focus on what is important and what is knowable. And what happened today with the Fed seemed to be within the realm of what has been telegraphed before. You have to look at the environment and say, okay, I have higher risk-free rates. I have a more constrictive policy. I have the economy slowing in some areas, and that is the backdrop. And we've been fortunate here at the Good Haven Fund. We've had very good 1, 3, and 5-year results, and none of it has been because we've been able to make slightly better guesses as to short-term interest rates than the next person. So we will continue to try and do what we think bring to the table.
No, I totally get it, right? Like, and all of this could change at the next Fed meeting, to be really completely honest, right? Or depending on the next set of data points. But having said that, Larry, you guys do have to make decisions. So how do you, first of all, do you pick like a 3-year time frame in terms of when you're making, or is it a 1 year? Is it a 5 year? Is it a 10 year? Is it shorter? What framework are you using to make investment decisions right now?
Carol, it's a very good question. And we're thinking very long term in anything that we purchase. We are stepping back.
What's very long term? Is it 10? Is it 10, 5, 10?
I would say anywhere from, let's imagine a 3-year on average holding period. I mean, our turnover ratio has been in the very low teens, so that would imply an even longer holding period. But first, there are plenty of confusing macro things out there. The first thing that I say to myself is this a period of an existential risk? The great financial crisis, there were existential worries there. The COVID, the tragic period and the lockdown of the economy, that was a potential existential risk. But what we are looking at today looks to me like one should assume this is the new normal, higher risk-free rates than we've had in a long time. The economy is slower in parts, but the sun is still coming up and businesses, things are still happening. And so once we conclude that there's not an existential worry, but there are things that are, there's higher deficits, all kinds of things, keep looking for businesses that we think can do well in such an environment and where we can buy them with a margin of safety. And that has worked for us over the last bunch of years, and we hope will continue to.
How do you think the consumer is doing right now? And I know this is, your investments are 5-10 years down the road, but now is an important snapshot to make these decisions. How is the consumer doing?
The consumer, I would say, looks to be, first of all, I've often said over the years that markets are much more volatile than the underlying businesses they represent. Having said that, over the last couple of years, I've noticed, and Artie Kwok and I here talk about this all the time, that the consumer and even business behavior is a little bit more volatile than it used to be. So I think the consumer in some parts of the economy seems much more constrained. Other parts of the economy, the consumer seems fine. So I think you have to take it. I think it's consumer spending in some areas, travel and leisure have been strong. Certain goods have been weaker. Luxury has historically been, more resistant to some of these issues. So I don't think you can just say the consumer, but I think it's a good question. And we then try and drill down a little bit beyond that.
So a listener and a viewer, Michael, thank you first of all for writing in and reaching out to our producer, Paul Brennan. He writes in and he asks, Larry, and I'm curious if you can weigh in. He asks, value investing hasn't worked for a long time, so how does an individual investor judge the past performance of a value-oriented mutual fund when considering a purchase? Also, is value investing working in more recent times?
Well, I like to first think that and I'm sure you have the statistics there in front of your trusted Bloomberg, that value investing for us and for our fellow shareholders has worked quite nicely over the last 1, 3, and 5 years, according to statistics that are right there, in front of you. I think that value investing sometimes gets a little bit, the term gets a little bit misused. There's nothing inconsistent in value investing with owning good quality growing businesses. And I think what has worked well for us and for our fellow shareholders is being right about the things that we bought, buying them at good prices, and not having any big mistakes in the portfolio over the last bunch of years. So I don't see, if you can execute on all those things, which is not easy, and why should it be easy? I don't see why value investing shouldn't always potentially work if you do a really good job at it. But of course, those are caveats, but I can only speak for what we've been able to do recently.
Yeah, I don't want to be a commercial for you, but the Good Haven Fund, if I look at the 1 month, the year to date, the 1 year, the 3 year, the 5 year, you are consistently either in for the most part, the 99th percentile. So basically beating all of your peers in that category. If I look at the 5 year, according to Bloomberg data, on average annually returning 11% to shareholders, 3 year, almost 20% to shareholders, 1 year, 26% to shareholders. And if I may, if I look at your holdings, it's Berkshire Hathaway, it's Alphabet, it's Jefferies Financial Group, it's Lennar, it's Devon Energy, it's KKR. And these are names
Builders
that...
First Source, don't forget that.
Oh, sorry, which one? Oh,
Builders First Source.
What is Builders First Source? That's what that's a top holding.
It's a top holding and an enormous contributor to our recent results. It is a buildings products
Up
distributor.
96% this year. Yeah, go ahead.
Up 96% and still trading at a very modest forward multiple to earnings and free cash flow. And we thank Paul Levy, who's the chairman of the board, and the rest of the management team, who has done a great job. And here's a shocking thing, Carol.
Yeah.
The stock is up dramatically in the last 6, 7, 8 years. Guess what? The earnings are up dramatically too. So when you get it right about the business and you buy it cheaply, wonderful things should happen to you eventually that the market will notice.
Well, and it's really interesting because this is a company that plays into, home building, which tells you a lot about the economy. Hey, do you want to mention Instacart just real quickly because we've had some IPOs this
Carol,
week.
this is one of my decliners. Don't give it away.
Well, it wasn't a decliner yesterday, but it's sliding, 11% to fall below the $30 IPO price. People were talking about the low float on this one, right? There wasn't a lot of shares out there and how that could be maybe problematic for investors. So we'll talk about it. Well, hey, Larry, we've got about 30 seconds left here. The IPO market, anything interesting? Does it tell you anything, too, also about the health of the overall market? Just quickly.
No, we have exposure.
This is why we like you.
No,
Yeah.
we have exposure to Jefferies, wonderfully run by the very talented Rich Handler, and so we hope that if there are more IPOs, we fully expect that their bankers will get more than their fair share, and so we cheer them continuing to do a good job if there is a more robust IPO market. IPOs are, not necessarily the things that we've historically focused on in the portfolio, but I'll think of where we will be cheering for them, and that's as fellow owners of Jefferies, which has worked out very well for us.
That's
over the
interesting
years.
exposure to IPOs, right?
Absolutely.
One of the companies one of the banks that handles underwriting.
Brings money into those firms. Larry, we always enjoy talking to you. You're specific. You aren't bashful, and it's really fun to get you to weigh in, certainly on this Fed Wednesday. Larry Pitkaski, managing partner, portfolio manager. He's also the co-founder of Good Haven Capital Management on Zoom from Millburn, New Jersey. Time to head over to our TV colleagues. Beyond the Bell.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld and Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast with our friends Carol Masser and Tim Senovic. Welcome to our audiences across all of our Bloomberg platforms here on Fed Day. Of course, the big headline, guys, is the Fed holding rates here at the September meeting, but making it clear in those projections that it expects rates to be higher for longer into 2024 and beyond.
Right, and it looks like, Romaine, that the Treasury trade certainly got that memo and that note and that message very clear. Your 2-year note now at 5.15. I mean, we're at the highest in since 2006, I believe. So we've really seen kind of a bit of a reset again, I feel like, this week and certainly on this day when it comes to rate expectations. And we just talked with Larry Pitkaski over at Good Haven, and he said, I love what he said, I think we're in a higher rate, risk-free environment without existential worries. So in other words, higher rates for longer, get it, but maybe without some big risks.
But here's the thing. When you look at the summary of economic projections, how can you know what's going to happen in 2024? How can you know what's going to happen in 2025? You really, as Yelena Shaleyev over at BNP Paribas told us, you have to take anything beyond this year with a giant grain of salt. We just don't know what's going to happen.
So Scarlett, should it not be considered a plan then?
He was very clear that this was not a plan. These are the median, the average forecast among, all these different participants who submitted their numbers. And by the way, economic forecasting is very difficult, guys.
I've heard that before. I heard that today, actually. From Fed Chair Jay Powell.
I mean, not if you have a crystal ball. I don't know. Do you guys not have one?
Yeah, we don't. Let's walk you through the market numbers here. We've been talking a lot about the macro, but it was a pretty busy day for equity markets. Obviously on pins and needles about the Fed, but of course you had an IPO today in Klaviyo, and not necessarily the best trading day for Instacart and ARM once again. The net effect of it all is the Dow Jones Industrial Average lower by about 0.2%. The S&P 500 giving back almost 1% on the day, or roughly 41 points, a close right around that 40 4,400 level, a key technical level there. The NASDAQ composite down about 200 points or 1.5%, while the Russell 2000 looks like it's going to finish out the day lower by about 0.9%.
All right, and quick look at the S&P 500 in terms of the names, about 173 to the upside, 328 to the downside, so certainly more of that risk-off trade, no doubt about it, and 2 unchanged, Scarlett.
Yeah, volume also slightly lower than the year-to-date average. Let's look at the sector performances here for the S&P 500. It was a down day for the major indexes, as Romain told us, but there are some sectors that did finish higher, including telecom names, healthcare equipment, and food, beverage, and tobacco. So you're seeing a lot of those dividend plays, those safety plays come out ahead. On the flip side, you've got a lot of those big tech names, media, entertainment, semi and semiconductor equipment companies, and tech hardware, along with software and services, all leading to the downside, all down by at least 1.5%.
All right, a little nervous making sure that my gainers actually held on to their gains, but let's go to it. Clavio, right? The IPO. It's been a big week.
Not all of them said Carol. Can we just get rid of that fourth one?
Darn it, gosh.
Yeah.
Well, all right.
Can you just block out her box?
You know,
wow.
Again, I'm here. I can hear this. All right, so Clavio up about almost 32% at its highs today, and its first day of trading as a public entity here, finishing up, though, with about a 9% gain. It was oversubscribed nearly, I think, 30 times. So, you know, it's interesting. Limited supply, another one of those kind of IPOs, but nonetheless, a gain, but lost a lot of that momentum that it saw earlier in the session. Pinterest, I want to go there because it's been on quite a 2-day rally, up another 3%. It gained 3% yesterday. Analysts were impressed by Tuesday's Investor Day, saying that the social networking company was upbeat and that the long-term targets look achievable. It's up roughly about 13% so far this year. And then Enphase Energy, once again, rallying up 4% yesterday, up another 1.5% today. News Monday, late Monday, after the close at co-director Thurman Rogers bought about $4 million worth of shares. It's the only news I could find, but it looks like still some momentum. Still down more than 50% year to date, and you got about 8% of the float shorted. Initially, a lot of other solar names were higher, which meant the Invesco Solar ETF was up almost 2% at its highs today, but finishing with a decline of 0.1%. So over to you, Mr. Decliner.
Handing it off to me. I'll take it. Let's talk about some of the stocks that moved lower on the day today. In the S&P 500, mega cap tech declining after the Fed's higher for longer message. Apple among the worst performers on a points basis in there. Microsoft there as well. Nvidia, Alphabet there as well. We should note that Dow Jones also reported a note from UBS's David Vogt that questioned demand for the Pro version of Apple's new phone, saying demand was not as strong as it was for the Pro models last year. And then Zebra Technologies, the worst performer on a percentage basis in the S&P 500, down 6.5% today. It's a company that makes barcode scanners, interactive kiosks, and more. Got downgraded to underweight from equal weight at Morgan Stanley. Morgan Stanley analyst writing that the pace of recovery at the consumer electronics company will likely be slower than expected. And then let's check in on Maple Bear. That's, of course, Instacart. The price for that IPO was $30. It closed today just above that IPO price. Yeah. So hung on to that, but still down 10.7% today. This after raising earlier this week, $660 million.
Do you know why it's Maple Bear?
No. Well, anyway.
Do we have something more important? Let's go to something more important.
Well, something more important, I would say, is the bond market. Yeah. I know there were some interesting single stock stories, but on Fed Day, of course, we got to take a look at what's happening across the Treasury curve, all the action in the front end. As you can see there, you have 2-year yields managing to rise 6-7 basis points, 5.15%. That is the highest 2-year yield since 2006. You go out the curve, not as interesting. You have 10-year yields. I'm going to call that unchanged. Your 10-year yield about 1 basis point higher, 2 basis points higher, 4.37%. That curve back to inverting rather at about negative 78 basis points remain.
Yeah, we actually still getting some earnings, believe it or not, here. That's kind of the last stragglers from the past quarter. FedEx out with their numbers here for their fiscal first quarter. Revenue coming in at about $21.7 billion. That's a smidge lower than what the street was looking for at 21.84. But operating income does look like a pretty solid beat at $1.59 billion versus a street estimate on average of about $1.34 billion. Here's your forecast here. The company basically saying that it sees full year adjusted EPS at $17 to $18.50 a share. The previous guidance it gave was $16.50 to $18.50, so effectively just raising the lower end of that range by about 50 cents. You can see the price reaction there, the knee-jerk reaction higher by about 2%.
And of course, when it comes to FedEx, what's notable, of course, is how it stands in contrast to UPS. UPS had to give big pay raises to its workers who had threatened to strike. FedEx, of course, is has been cutting costs and has been doing that. And the CEO says that they're well positioned to deliver, they've started fiscal 2024 with strong momentum and are well positioned to deliver improved profitability. So kind of just putting that out there and reminding everyone.
Yeah, they're not apples to apples when you look at FedEx and UPS. We often talk about their different models, but man, investors have been really sitting up and taking notice of what FedEx has been doing in terms of transforming the company. I mean, it's up more than 40% this year. You've got UPS down about 9%. There, of course, have been, concerns with the strikes and so on and so forth. So very different stories for these, but it really does feel like Wall Street investors have taken notice of what the changes they've made.
But it's interesting, too, to look at this report as well as a couple of the reports and to sort of tie that into some of the questions that Powell was peppered with here. This isn't a revenue growth story. I mean, this is cost cutting. And I think this is the fear that a lot of investors have, that, that's great in the short term. It gets you through the quarter and it bolsters the stock price. But how much longer do we go like this, particularly if you do believe that rates are going to stay higher?
Yeah, the press release, Romaine, literally spells that out. It said that first quarter results improved primarily due to the execution of the company's DRIVE program and continued focus on revenue quality. But, and this is a big but, the improvement in operating results was partially offset by ongoing demand weakness.
That's the thing. I mean, it's you can cut costs. No one's poo-pooing that, right? But you can't sort of cut your way to prosperity, more or less, right? And you sort of wonder what the strategy is for FedEx. And we don't want to just pick on FedEx here. A lot of other companies are in the same boat as them. Other blue chip companies are in the same boat as them. And I wonder if that's sort of the next thing that the Fed really has to be mindful of. We've so focused on the consumer and the homeowner, but we forget there's stresses out there for businesses as well.
But maybe against this backdrop, that's good enough. And you can see that in the share reaction after hours. FedEx shares up 2.5%. To your point that, I mean, that's not necessarily growing, that's cutting costs. But you think about some of FedEx's peers, maybe cost cutting is good enough to make it stand out.
Well, and sometimes you have to clean house, right, to get to a better business strategy or business equation. I do also want to mention that, and could be another reason why the stock is popping, company expects to buy back an additional $1.5 billion in shares during fiscal 2024. We see companies doing that a lot, when they've got some excess cash. Again,
so $1.5 billion to buy back the stock.
Right.
Not into CapEx, not into the business.
It's not building the business,
okay, gotcha.
Paying workers, whatever.
Okay.
But it allows you to buy time while you wait for things to recover, right? I mean, Jay Powell made it really clear that the economy is doing better and holding up better than a lot of people anticipated, certainly than the Fed anticipated. And so demand might be more muted than it was before the rate hikes, but it's held up for the most part.
No, you do wonder, right? You can't cost cut your way to, a really strong company, but you can certainly make investors happy maybe for a little while. So more to come, certainly, on that story. Guys, that's a wrap. All right, that'll do it for our cross-platform coverage.
Happy Fed Day.
Happy Fed Day.
Good to see 5 of us.
Yeah.
Did Tim say big butt before?
No.
He did. You did. It's a big butt. You said that.
Oh, okay.
Sorry.
I did.
I know. I'm being like an 8-year-old again. That's a wrap. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. We will see you again tomorrow. Carol Master along with Tim Stenovec. And moving out of your parents' place and living on your own is often seen as a marker of adulthood. For sure, right? Forever, Tim, it feels like.
I mean, yeah, that's like what you're supposed to do, right? You turn 18, maybe you go to college, maybe you get a job, but you don't live with your parents anymore. However, dealt with an onerous set of cards, including pandemic lockdowns, decades-high inflation, soaring student debt levels, and a shaky job market, young people today are increasingly staying put. Carol, what's more, living at home is no longer seen as a sign of individual failure.
It's really interesting. I know a lot of folks, actually, who certainly coming off the pandemic, right? It's really tough. So let's get into it, because all of this is in one of the most read stories on the Bloomberg today. It's written by Claire Ballantyne and Paulina Cachero. Claire, by the way, personal finance reporter at Bloomberg News. She's here with us, along with Craig Giamona, personal finance and wealth team leader here at Bloomberg News. Craig here in our studio. So, Craig, first of all, I just want to get to how this story came to be and how you guys were thinking about this. I mean, you guys actually worked with Harris, right?
We did, yeah. We keep a close eye on trends like this. I mean, a lot of this stuff bubbles up out of conversations we have with friends or people that we're hearing about, and then we go and check the numbers. I mean, I think it's something that really caught our eye was that this surged in the pandemic. I mean, I think June 2020 was the peak when we got to 48%, and we're still at levels not seen since 1940. So that caught our eye. We're trying to document trends, how society is changing, how we're emerging from the pandemic. So I think that number really said to us, let's run after this and see if we can find something.
I think what's wild to me is that 1940 statistic, Craig. I mean, describe the world for us in 1940, right? The post, during World War II, of course, and then part of it is being in this post-World War II environment when baby boomers were born. But, what are the similarities between now and then?
I mean, I wasn't around then,
yeah,
but I know a little bit. Obviously, a very, very different world, right? I mean, I think women lived at home until they got married. Men were working on the farm. So if you look at the chart, it's basically an upward trend from 1940 straight until now, until the pandemic. People moving to cities more. There was that trend of people, going back into cities. But like you said, this is something that you do. You go to college, you get a job. You're dying to get that first apartment, whether it's 5 roommates, packing in. Everybody does that. And the fact that I think that this has ebbed now coming out of the pandemic is pretty fascinating.
All right, Claire, come on in on this story and talk to us about how, as you guys, obviously the survey was put out there and the data comes back and all of this is unfolding and you guys are going through it.
Yeah, I think what was most interesting to me as we were getting the numbers back from Harris Poll was just, not only how many young people are living at home, but how they're not ashamed of it. And both the responses that we got from the young people and from Americans at large both showed that it's more acceptable than maybe it was, 5, 10, 20 years ago to live at home for longer. And I think we're seeing Gen Z especially think of this as sort of a new normal. In the survey and then also in people that I talked to, not only were they living at home, but they knew others that were. It was something their peers did. It wasn't seen as out of the ordinary or like a failure. And that was what was most notable to me.
Claire, who's living at home? Is it people who are 18, 19, 20 who never actually leave the nest? Or is it people who go out and then come back as a result of, being unable to buy a first home, for example?
It's both, I think. I mean, there are some people that are eschewing college now, just thinking it's not really worth the investment. Maybe they're working jobs and they're living at home. There are people who maybe moved out to live in dorms or apartments around their college and then decided to move back home to save money. And then there's also some I talked to that had been out on their own for a few years and were paying rent and just increasingly realized they're throwing their money away and they could be saving it while living at home and then potentially buy a home one day or just become more financially stable in some way.
Go
I just
ahead,
want to
Joe.
say, for those who are watching on YouTube and Bloomberg Originals, there's a great chart up there, and I actually wanted to go to it because at the top of the list is 41% saying the reason that they did this was to save money, and there are instances in there where folks said that was a way that they could actually kind of improve their financial standing, Craig.
I think housing is right in the middle of this, right? I mean, we saw the housing market go crazy in the pandemic. Now mortgage rates are above 7. So the normal cycle has been thrown off. There's wealthier people that are still renters. That's driving off rent because those people can't buy. So I think rent in cities like New York, Austin, Miami, I mean, rent has gone crazy. Talk to somebody who's tried to rent an apartment in New York City lately. I mean, again, these are anecdotes, but you just hear stories that are hard to comprehend. I think the idea of like moving to a city and being able to afford the rent on an entry-level salary, that equation is a little bit thrown off. I do think that's at the heart of this.
I wonder, Craig, about like a cultural shift happening here. One thing that's different here in the U.S. is we haven't traditionally done multi-generational living in the 20th and 21st century. And it's not like that in a lot of the world.
True.
You oftentimes have 3 generations living, and I think a lot of students who study abroad and live with families start to realize this. I certainly did when I studied abroad. Are we going to see a shift, do you think, as a result of these high prices?
It's very possible. I mean, there's just not enough places to live. We've underbuilt now for 30 or 40 years. The price of these homes has gone crazy. So I would not, I mean, think of it, not to get into a whole other subject, but the price of senior care and health care and the issues toward the end of people's lives, how expensive that stuff gets. I mean,
again, a uniquely American thing for us to send the eldest in our in our lives away. Oftentimes in most of the world, they live at home.
Right. So I don't know. I mean, that's very, very possible. I think that's what we're trying to identify here. I mean, I think this stuff was said about millennials too. The financial crisis was very hard on that prior generation. Millennials have kind of caught up now, right? A lot of them are homeowners. There was just sort of, it took them a little longer to get to where we think they should be than it did prior generation. So the question now is it just delayed because of how the economy is, or is there a fundamental shift that's going on? on now.
Yeah, I think about like kind of growing up, you know, my mom lived with her parents, and there was grandparents, and there was an aunt, and it's just kind of the way they did it. And you're right, like when people got older, you just kind of took them in. You didn't kind of farm them out.
I mean, I got to tell you, I have a really good friend, lives in California, an area of very expensive housing. He's a doctor, so he makes a lot of money. His wife is a nurse, and his mother-in-law lives with them, and he says it's amazing. They have 2 kids. They're all one unit. And he describes it like it's a dream. He and his wife can go out to dinner, and she watches the kids, and it's just she builds a close relationship with her grandkids.
Yeah, I almost feel like during COVID, right? We were kind of everybody was taking in family members. Claire, one thing I think about too, you're personal finance reporter. Craig obviously overseeing the personal finance and wealth team. But how do you think about it when it comes to personal finance? So for some, this gives them an ability to actually build up some savings and maybe invest, which plays into the financial markets, but it also means that they're not necessarily going out there buying homes and kickstarting the economy that way. So it's interesting to kind of get these data points and think about the implications of it.
Yeah, well, that's very true. I will say, though, that for some of these people, if they're saving so much money on rent by living at home, for a lot of young people especially, that money isn't all going directly into responsible saving and investing. Some of that money is also going towards lifestyle and dinners out, clothes, things like that. So, even when maybe the intention is to put all of that cash into savings, I would argue that potentially there's even more spending happening on discretionary goods because they don't have to pay rent.
Taylor Swift tickets.
No, live with your parents so you can afford Taylor Swift tickets. Hey, Claire. I mean, we're kind of joking around.
That was the
other
headline you thought about, right?
But I do have a question about this. I mean, we know the people who live with their parents are increasingly okay with it. What do the parents think? Do we know what they think about it?
Great question. And we actually asked that in the Harris Poll survey as well, because, you hear about that anecdotally, parents that are like, oh, my kid will not move out. But surprisingly, parents were more okay with it than I think many expected. I don't have the stats right in front of me, but anecdotally, they were okay with it. I mean, I think a lot of them understand. Everyone that I talked to, the kids at least, I said, what do your parents think about this? And some of them said, my parents love having me here. They love having me around. Some of these kids are pitching in and helping their parents. It depends on the circumstances. But in some cases, they're contributing to the household income by living at home. So it's better than I think the headlines make it out to seem. It just depends on the situation.
Craig, final 10 seconds.
It's going to be very interesting to see. I don't think the housing situation is going to get better sooner, right? So you're going to see some interesting things develop as we, continue to emerge from the pandemic.
Craig Giammona, he is personal finance and wealth team leader, and of course, our thanks to Claire Ballantyne.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long at Bloomberg. Fed Wednesday and a move lower for the Dow, the S&P, and NASDAQ. And this update is brought to you by Glenmead. Glenmead offers sophisticated wealth and investment management solutions combined with the personalized service you deserve. Your wealth, your mission, your investments. Let's talk. Visit glenmead.com to learn more. S&P today down 41 points, a drop there of 0.9%. Dow Jones Industrial Average down 76, a decline of 0.2%. NASDAQ was down 209, lower by 1.5%. 10-year yield now at 4.38% on the 10-year. We've got the 2-year yielding 5.16%. Spot gold 19.31 the ounce, and West Texas Intermediate crude was down 1.3%, 89.31 a barrel on WTI. Stocks fell, bond yields rose, with the Fed signaling interest rates will be higher for longer after staying on hold today. Here's Fed Chair Jay Powell.
Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go.
And Powell's remarks were heard live on Bloomberg Radio. Instacart shares down 10.7% today. Instacart briefly sank below its IPO price on just its second day of trading, underscoring the difficulty the company will have convincing investors of its plans to expand into advertising and the grocery software business. Again, recapping, stocks lower today with the S&P down 41 points, down 0.9%. 10-year at 4.39% with a 2-year 5.16%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thanks so much for that update, Charlie Pellet. Get the latest news whenever you want it with Bloomberg News Now. Top stories from our global team of reporters at the click of a button. Get Bloomberg News Now on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
All right, as you know, FedEx just out with earnings, stock rallying in the after hours. It's also been on a tear this year, as we talked about earlier, up more than, I think, 40% this year, but up another 4% in the aftermarket. Let's get to it. Let's see what our Lee Klaskow has to say. He follows this company and the sector. He is Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst, and he joins us at BI headquarters in Princeton, New Jersey, and he, like us, has just been going over the numbers. Why the optimism, do you think, in the aftermarket, Lee? And first of all, thanks for being with us.
Oh, my pleasure. They beat expectations, so that's obviously a net positive. They beat by 80 cents. They also increased the low end of the range of their guidance by 50 cents, which is another positive. And, the beat is what's telling us is that management is beginning to execute on its strategy to cut around $6 billion in expenses. FedEx for a long time has been a show me story, and they're actually starting to, I guess, not show me, but show people that they're able to execute on their plan. So, I think that's what's fueling the aftermarket increase that we saw. I think it's up like $10 right now.
Okay, so that's the good news, because I'm looking through this release and I'm seeing a little bit of bad news in here. So correct me if I'm wrong, Lee, but the improvement in operating results, I'm reading this directly from FedEx's press release, was partially offset by ongoing demand weakness. Talk to us about that demand weakness, where they're seeing it, and how long it's going to last.
Yeah, I mean, that's a great question. I think demand expectations are going to be weak because you have to remember demand is really normalizing from, some creamy highs that we saw during the pandemic when everyone was ordering things home. So, now that, people are getting back to normal, obviously people have been spending more on services versus goods. We've seen that trade happen already. So they're really going up against difficult comparisons versus anything that might be, in our view, like a real weakening of the consumer. We think the consumer remains relatively resilient. So, So that is really not a surprise. The good news is what's offsetting that is what they're doing on the pricing side. So, they just recently announced that they're going to increase rates next year by 5.9%. That's their general rate increase. Obviously, large shippers aren't going to pay the whole that whole increase. They'll probably pay a discount of that. But what we're seeing is that they're going to be able to increase price to lower their inflationary pressures. And you can see, what they're able to do on the cost side. They mentioned in the release that they reduce the cost per package in ground to ship those packages by around 2%, I believe. And so that's good news. So that means that they're getting productivity gains. They're cutting some of the fat that FedEx had. And, net, that's a good thing. So when demand does increase, when demand does go back to growth, they're going to be really well situated because that's really going to drive significant operating leverage and really good incremental margins going forward.
Lee, this was something we were just talking with our TV colleagues as we were breaking down the FedEx numbers as they crossed the Bloomberg. Should we be rewarding this company because they're good at cost cutting? This isn't about investing in CapEx, it doesn't feel like, right? Or, putting money to work or demand is up a lot or, the top line is growing a lot. You know what I'm saying? That, and they've got another buyback, which always gets investors excited, or an additional cost cutting.
It is today versus where it was a year ago. The street was really soured on FedEx for a number of reasons. A lot of that was just poor execution. And, they've come up with a plan. They're executing on the plan, which again is very key for them. They need to really show that they can execute. And if you look over the last 5 years, the shares actually have underperformed its biggest competitor, UPS. So, they are rewarding it today, but it's really a function of catch up versus necessarily something else.
Talk to us about the labor differences. Carol alluded to this during our simulcast, the fact that UPS is a story that is really a labor story with a really strong union.
I learned this from Lee when I was doing a big deep dive into UPS, and we talked a lot about the differences between the two companies.
But you look at a FedEx ground truck, and you look at the fine print, and maybe I just look at the fine print. Maybe not everybody does this, and you see that it's run by a company that is not FedEx at all. It's contracted out. This is contract labor. These are not actually FedEx employees. Talk to us about the labor differences here.
Yeah, so obviously, there was in the news, obviously, a couple months ago with UPS kind of making an agreement with the Teamsters. That's their union that works and delivers all the packages. FedEx does have a union, but it's only their pilots. The rest are either employees or, as you mentioned, they're independent contractors. FedEx was an air freight network that decided to go into the ground business, and they did that in an asset-light sort of way by really relying on these independent contractors. And there's hundreds of them across the country. They own certain regions. They're small business owners. They're able to sell those businesses to other people. So they operate as a small business. What I would say is with the new UPS contract and the fact that UPS is unionized, labor markets still are relatively tight. And if you're thinking about that's something maybe you want to go do for a living, working for a UPS where maybe you're getting a better rate per hour and your benefits are better, it might be more appealing. So from a attract and retain employees, UPS might have a leg up, but in terms of flexibility and maybe total cost per employee, FedEx obviously has the benefit. But if you look at the two differences, UPS's margins on the domestic ground side are a lot better than FedEx's margins right now. So that cost difference really isn't showing up in the profitability in the P&L.
In the press release, they talk about operating income up 18% during the quarter, as a 9% decline in revenue was more than offset by reduced operating expenses. It's what we've been talking about. That 9% decline in revenue, is that you talked about kind of getting back to pre-pandemic levels, right? Things got distorted during the pandemic. We know that. And I guess we keep trying to remind everybody, wait, we got to get back to kind of where we were. That's the reset. Does the FedEx numbers show that we are kind of closer back to that reset or pre-pandemic?
I think the jury remains to be out. My guess is that I think that we are closer to that. And I also think that, some of the things you're seeing on the yield side, some of the lower yields might be related to mix, but some of that business might still be more profitable for them, even though from a headline number, it might not look that great. And you also have to remember fuel surcharges are kind of down from when they were a year ago, even though we're seeing, higher fuel rates. What I was surprised is the FedEx Freight business, which is their less than truckload business. They had a lot of opportunity to win some business when Yellow went out of business. And so I thought there'd be more of a kind of a surprise on that side. But that segment actually, missed expectations by a couple hundred basis points.
Okay, so what's the question you'd ask on the call if you were on there?
You're sitting down, or you're having cognac with the CEO, and you're like, hey, just between you and me, what are you going to ask him?
I can't believe you knew I was a cognac kind of guy.
Aren't we all?
I think I would want to know what inning they are in the $6 billion in cost reduction, and not only what inning they are in, but how much more can they really do? Because that's really the key. This company has to be really ready for the next generation of parcel. They're facing increased competition from Amazon. They're starting to do pickups, which is something that they had a test pilot project that they did before the pandemic, and they paused it. Now they're redoing that.
Right.
So they're facing competition from other areas. So they really need to be more efficient, and they really need to help their independent contractors be profitable, so they reinvest in their businesses and they're able to keep those high service levels up.
All right, so appreciate it as always. Lee Klaskow, BI, Senior Transport, Logistics, and Shipping Analyst, joining us there from Princeton. Stock up, by the way, FedEx, 4%.
Time for World and National News. Nancy Lyons is in the 991 Newsroom in D.C. Hey, Nance.
Thanks, Tim. Attorney General Merrick Garland today appeared before the House Judiciary Committee and defended the work of the Justice Department. Republicans have accused the DOJ of slow-walking the Hunter Biden investigation while throwing harsh penalties at former President Trump.
Our job is to pursue justice without fear or favor. Our job is not to do what is politically convenient.
Garland says his department will not back down from defending our democracy. With COVID-19 cases ticking higher, the Biden administration announced today it's providing $600 million in funding to produce new at-home COVID tests. You'll be able to request 4 free tests per household by going to covidtest.gov beginning on Monday. Well, the debate continues in the House as Republicans remain divided on whether to keep the government open past the September 30th deadline or allow a shutdown. House Speaker Kevin McCarthy.
I don't know if any of you ever played sports. Did you quit before the game was over? If you went into overtime, did you quit during that time too? I think this is where the most significant change happens. And that's why what we're going through right now, and I'm going to stay with it and solve the problem.
McCarthy says he's asked the White House to work with Congress. There's still no deal between the United Auto Workers Union and the big 3 Detroit automakers, although Stellantis has upped its offer. Bloomberg's Detroit Bureau Chief David Welch.
UAW President Shawn Fain said that unless there's some real significant progress, which he didn't define, if that didn't happen by noon on Friday, then he would add plants to the 3 that he already has on strike. And I would assume they'd be pretty profitable plants, but we'll see who he picks.
Again, Bloomberg's David Welch. Global news 24 hours a day, powered by more than 2,700 journalists and analysts.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long. And we do have FedEx shares trading higher after earnings. FedEx now up by about 5.2%. FedEx posted profit. A regular Wednesday, but a Fed Wednesday. Stocks fell, bond yields rose, with the Federal Reserve signaling interest rates will be higher for longer after deciding to stay on hold today. Larry Pitkowski is managing partner at Good Haven Capital Management, and he was a guest right here on Bloomberg Business Week.
What we are looking at today looks to me like one should assume this is the new normal, higher risk-free rates than we've had in a long time. The economy is slower in parts, but the sun is still coming up and businesses, things are still happening.
And you can hear more of the conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. S&P today down 41, ending the day at 4402, lower by 0.9%. Dow Industrials down 76, a decline of 0.2%. NASDAQ was down 209, a drop of 1.5%. 10-year yield 4.39%, with the 2-year 5.16%. Gold down $1.28 the ounce to 1930, down 0.1%. And West Texas Intermediate crude down 1.2%, 89.39 a barrel. So again, recapping here, stocks move lower. S&P down 41, drop there of 0.9%. Those yields, Treasury yields, worth repeating. 10-year 4.39%, with the 2-year 5.16%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much, covering so much on this Fed Wednesday for us. Bloomberg News reporting earlier this month observing methane releases from global oil and gas operations that were 30% higher than what countries estimate in reports to the UN. This is according to a new study, right? And it analyzed satellite observations of the potent greenhouse gas. It's really important.
Yeah, it is. The world's 4 largest oil and gas emitters, the U.S., Russia, Venezuela, and Turkmenistan, account for most of the overall discrepancy. That's according to a report published last month in Nature Communications. Satellite data, it just challenges, though, figures that reported to the UN, which rely on so-called emissions factors. Those are estimates for how much methane equipment might normally release applied to production and use rates. So it shows what you see in sort of one measurement.
Correct.
Might be different than what satellites pick up.
Exactly. And satellites, folks, they're everywhere. They're doing all kinds of things. You know that. And we're going to put that question because our next guest knows a lot about this. Let's head to Munich, Germany, where we find on Zoom Peter Platzer. He's a physicist, founder and CEO, too, of the publicly traded microcap and global provider of space-based data analytics and space service. The company is called Spire Global. Peter, so nice to have you here on Bloomberg Business Week. Welcome, welcome. Tell us about your business and what you guys are doing.
It's fantastic to be here. Thanks for having me. Spire was founded to leverage space and analytics to improve life on Earth. And infused with that vision, we designed, built, and now operate the world's largest constellation of satellites that use radio frequency technology, the technology that powers anything from mobile phones to the very show that we're on right now, to observe what is happening on and around Earth. We collect a lot of environmental data, like hurricane wind speeds and flooding and wildfires and other extreme weather events. And then we help our customers to improve their bottom line by reducing often their carbon footprint, all at the same point in time.
Do you guys actually own satellites?
Yes, we own the satellites. We own orbit that cover the Earth every 15 minutes, all of Earth, everywhere, 24/7, and we invent.
Oh, we got to get those satellites fixed so we can get this interview going.
All right, I think, are you back? Oh, you're back with us. Okay, go ahead. Continue what you were saying.
Oh, sorry. I was saying that, yes, we built and designed all those satellites and we invented all the technology that sits inside the satellites, the sensors, and the software.
So explain how these satellites that you launch at Spire Global are different or similar to ones that are launched by SpaceX's Starlink.
So we call the satellites categories: looking satellites, talking satellites, and listening satellites. Starlink is a talking satellite constellation. They transport data from one spot on Earth to another spot on Earth. They are data pipeline, so to speak. Spire is a listening company. We use radio frequency wave to observe what is happening around Earth. So when you, for example, mentioned earlier, methane emissions, we are a platform for a customer that runs a sensor that measures methane emission from space. We have a sensor that uses radio frequency waves to measure hurricane wind speeds or flooding or rain or temperature. So we use RF technology, radio technology, to literally observe what is happening on Earth.
So I'm curious, how much of your business revenues comes from government organizations around the globe?
So about 45%, so a little bit less than half of our business is with government organizations. It has sometimes been a little bit more than this. It has sometimes been a little bit less. So maybe over a longer time frame, we say 50-50. But right now, it is about 45% from the government side and 55% from commercial companies.
So when investors look at you as a company, as I mentioned, you're a microcap, and let me just take a look real quick. $113 million microcap. You're down about 33% for the year. But how should investors think about you? We do classifications. We say information services, but it's interesting. I feel like you're playing into a lot of different fields. How should investors think of you? What kind of company are you?
We are a classic SaaS company. We sell data and analytics as a subscription. We have.
All right, I think
here is 130.
Oh, go ahead. For some reason, we lost sound. Go ahead, pick up again. So you said you guys sell data and analytics.
Sell data analytics as a subscription. Our customers are extremely sticky. We have a net retention rate of 117%. So customers keep on buying more from us. We have a guideline for this year is over $130 million of ARR. Growth rate over the last 6 years is over 100%. So we are a classic data and subscription company. With the same metrics as you would find with typical SaaS companies, with the one difference that we have an extremely efficient sales force because we have these massive barriers to entry, and we don't really have to spend as much on sales and marketing as you see with other SaaS companies.
Peter, who launches your satellites?
So there is a rocket going up on planet Earth every 2-3 days or so. We have launched with at least 10 different launch providers, 35 launch campaigns. So we have launched with anyone from SpaceX that you mentioned earlier to Rocket Lab to Virgin to India to the Europeans, Vega. So a whole host of launch vehicles we have used to bring our satellites, our capabilities to orbit.
I'm wondering what you would say to critics who argue that filling the sky with satellites, a lot of astronomers say, it's really changing the night sky. It makes it look completely different than it looked just a few years ago. It's affecting the way that we can explore Earth. What would you say, or explore the solar system? What would you say to them?
So I think it's absolutely true that space is a common environment, just like the oceans or peatlands that we monitor, which is a great carbon storage and has huge impact on climate change. Space is a shared, common good, and we have to treat it, very, very respectfully. Now, putting up very, very large devices, for example, does have a massive impact on astronomers. I would challenge any astronomer to see our satellites because they're the size of a bottle of wine, and they're not very shiny. So they're really, really very, very invisible. I think you have to treat it respectfully, which we certainly do. We clean ourselves up very, very quickly.
Right.
And we do have to look at the benefits as well as the cost of leveraging this common good space.
All right, got to run. Hey, good to check in with you, and hopefully we can do it again in the future. Peter Platzer, he's the founder and CEO of Spire Global, joining us from Germany.
A little sublime.
Yeah.
Yeah. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. After the bell, FedEx posted profit that topped analyst estimates and raised its earnings forecast thanks to cost-cutting, strong pricing, and customers who switched to the courier from its main rival, UPS, on concern over a potential strike. Bloomberg Intelligence senior transportation analyst Lee Klaskow was a guest right here on Bloomberg Business Week.
You know, the beat is what's telling us is that management is beginning to execute on its strategy to cut around $6 billion in expenses. FedEx for a long time has been a show me story, and they're actually starting to, I guess, not show me, but show people that they're able to execute on their plans.
Instacart today briefly sank below its IPO price on just its second day of trading, underscoring the difficulty the company will have convincing investors about its plans to expand into advertising and the grocery software business. Coty is raising its sales outlook for the current fiscal year, citing continued robust demand for higher-end fragrances. The maker of Burberry and Gucci fragrances now sees like-for-like sales growth of 8 to 10% in the fiscal year that started in July. That is up from the 6 to 8% sales growth forecast that the company gave in August. So again, after ours, FedEx shares are rallying after earnings. FedEx shares now up by about 5.5%. And those are our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
This is Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenivek and Carol Massar live from the Bloomberg Interactive Brokers Studio in New York. Let's go to Washington, D.C. now for a check on the latest world and national news. Nancy Lyons is in the Bloomberg 99.1 newsroom. Hey, Nance.
Thanks, Tim. Attorney General Merrick Garland was in the hot seat today as he testified before the House Judiciary Committee. His appearance came as the House conducts investigations into President Biden and his son Hunter Biden. Garland pushed back on Republican claims, though, that politics is entered into his decisions.
As the president himself has said, and I reaffirm today, I am not the president's lawyer. I will add, I am not Congress's prosecutor. The Justice Department works for the American people. Our job is to follow the facts and the law, and that is what we do.
This is the first time in 2 years the committee has heard testimony from Garland. Senate Majority Leader Chuck Schumer is trying to outmaneuver Republican Tommy Tuberville, who's been blocking military promotions over the Pentagon's policy allowing service members to travel for reproductive health care. Schumer has set up votes on 3 top military leaders, the chairman of the Joint Chiefs of Staff, the Marine Corps Commandant, and the Army Chief of Staff. He's taking action before Tuberville can try his own procedural move.
These 3 honorable men will finally be able to assume their positions, and the abortion policy that Senator Tuberville abhors will remain in place. Senator Tuberville will have accomplished nothing.
Schumer says if senators do not go along with the votes, he's ready to keep them in Washington through the weekend. House Speaker Kevin McCarthy says Republicans are making progress on averting a government shutdown.
Look, it's not September 30th. The game is not over, so we continue to work through it. And I've been at this place many times before, and we're going to solve this problem.
McCarthy today decided to hold off on taking a vote on an interim spending measure that emerged from negotiations last weekend, and he says he's unwilling to commit to trying again tomorrow. Global news 24 hours a day. Back to you, Carol and Tim.
All right, Nance, thank you so much. Carol Massar along with Tim Stenivek live here in our Bloomberg Business Week studio at Bloomberg headquarters in New York City. A lot going on here, and it's been a busy week when it comes to IPOs and other things, but what's top of mind for you?
Yeah, the UAW strike still continues to be top of mind. We've got a great team, including David Welch out in Detroit, along with Keith Naughton, Gabrielle Coppola, Craig Trudell's all over. I mean, just a fantastic team that's been all over this strike. The latest from David Welch is about how GM and the UAW remain far apart on a deal after the union rejected the automaker's offer from 5 days ago that would raise average compensation to $150,000 a year. That's according to people familiar with the matter.
Yeah, so what's going to happen? I mean, so a deal still elusive. GM CEO Mary Barra telling salaried staff in a webcast today that the UAW's latest counteroffer is still too expensive. The people said, according to those in the know, and who, of course, requested anonymity because her presentation was private. Barra comparing GM's labor costs of $67 an hour, including benefits, to $45 paid by electric vehicle rival. We're talking about Tesla, and said it would grow as a result of the current offer.
This is the heart of the matter,
Yeah,
Carol.
different models.
It's the transition to electric vehicles and what that does to the century-old auto industry in the Midwest of this country.
No, you think about it, right? Elon Musk from out of the gate has been doing it differently, right? In terms of how they sell cars, how they do everything.
But it's not just Tesla's model.
No.
It's the fact that EVs take far fewer people to build than a drivetrain
It's a different
on an
machine.
internal combustion engine. Some estimates say it's 40% fewer people to build one of these vehicles.
And I keep thinking about, for somebody who's running an auto company, and, there's points made that when they were making record profits and doing really well, like sharing the wealth. Having said that, if it becomes too expensive in terms of their costs, what does this mean for the future of these businesses?
Yeah, especially as the businesses are trying to transition to...
Yeah, transitions are difficult.
They are.
Horse and buggy, went to car. You think about some of these significant transitions we've had in our world.
How do they do it also when, your biggest competitor doesn't have union labor, Tesla?
It's not easy, and that's why this is kind of strangled or tough negotiations. All right, more to come, guys. Don't go anywhere. You're listening and watching Bloomberg.
is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
Hi, everyone. Bloomberg Business Week continuing on this Fed Wednesday as kind of the sun comes into our studio.
Is this Masterhenge?
This is Masterhenge.
We're getting to that time of year.
I'm going to take a picture. We're live in our Bloomberg Interactive Broker Studio with the sun streaming in for those watching on YouTube and, of course, Bloomberg Originals. Rat infestations, blocked fire exits, machete-wielding customers. Where do you think you are when you hear that?
I mean, I know where we are because I read the amazing cover story in Bloomberg Business Week. It's why working at Dollar General is so awful that even investors are worried. I mentioned it's this week's cover. We're going to have one of the reporters on it. We're going to have Joe Weber in here in just a few minutes.
Yeah, I mean, this story is unbelievable. And what's up with Meta? Why can't we search on murder, marijuana, opioid, or even skinny? What's up with that?
I don't know. We're going to have to ask Alex Branca. She'll know the answer.
We will. And then charting the internet's next economic and cultural frontier. We've got the author of a new book, Alex Tapscott, back with us, actually, to stop by to talk about Web3.
First up, though, a check on the day's trade and top business stories. Here's Charlie Bellet.
Hi, thank you very much. After the close of trading, we heard from FedEx. Shares up now by about 5.5%. FedEx posted profit. The top analyst estimates it also raised its earnings forecast thanks to cost-cutting, strong pricing, and customers who switched to FedEx from its main rival, UPS, on concern about a potential strike. Again, after hours, FedEx shares are up by 5.5%. From FedEx to the Fed, the Federal Reserve left its benchmark interest rate unchanged and signaled rates will likely stay higher for longer to contain inflation. And with more on that story, here's Bloomberg's Vinny Del Giudice.
Fed officials wrapped up this month's policy meeting, signaling one more rate hike this year. They meet again in November and